Markets leaning into expectations of a rate cut in September by the Federal Reserve, and Bank of America CEO Brian Moynihan urging the central bank to cut rates in an interview yesterday. Meanwhile, Federal Reserve Board member Michelle Bowman voicing caution on adjusting the current stance of policy. Joining us now, Goldman Sachs Vice Chair and former Federal Reserve Bank of Dallas President Robert Kaplan. Good to see you. So a lot of movement over the past couple of weeks, but it does seem as though the market expectations at least have come back around to a quarter-point cut in September, no emergency meeting, maybe not a half-point cut. I'm just curious how you're thinking and sort of what you've reflected on as you have seen all of the volatility and expectations.
Yeah, so I think the market expectations sound about right to me. We'll know in early September when we see the August jobs report whether the July report might have been a little bit more of an aberration than we might have thought. I know the BLS said that weather did not affect that report, but there was a substantial hurricane in Houston, and a meaningful percent of the layoffs in the July report were temporary. That's unusually high. So we may get some rebalancing in views. I still think the most likely case is 25 basis points in September, but the Fed will look very carefully at the August jobs report and the intervening data, and they'll have all their options open, including doing something more than 25 if the job market is a lot weaker than we expect.
Robert, I'm curious, when you're looking at the dynamics right now and the slowing that we have seen in the labor market, yes, even taking out Hurricane Beryl, the unemployment rate has been ticking up for several months now, and we know that that can be perhaps a scary trend if it continues on that, as it often does. How are you assessing that side of the risks right now? Are the risks significantly more elevated there, only starting to become more elevated? Where do you think we sit in terms of the labor market and perhaps maybe policy just being too tight right now?
Well, we know manufacturing is weak. It's been weak for some time. China overcapacity accelerates that weakness. We know the labor market is cooling and rebalancing, and so it's a fine balance. We wanted the labor market to cool. We wanted, probably given the supply increase in labor, it should have been expected we were going to get some increase in the unemployment rate. The question is, you don't want it to weaken substantially from here, where the unemployment starts getting away from us. I think the reason, from a risk management point of view, you want to start cutting in September, and we'll see how much the Fed decides to do. Is you want to see the risk now as more balanced between inflation and unemployment. Having said that, the inflation fight is not over yet. And that's why if they skip July, I understood why they skipped July.
So, Robert, if indeed you do start to get some worsening jobs numbers, because there does seem to be a fairly broad view here that the Fed is late, that it is behind the ball, even if that doesn't sound like it's your view. Because on the way up in rates, you see these so-called long and variable lags, the effect in the economy. If the Fed cuts in September, partly in response to a weakening job market, how quickly does that then help?
Yeah, there is a lag. Part of the effect of cutting is psychological, and part of it will have a lag. The issue is, if the Fed misses cutting by a meeting, or even a meeting or two, I think in hindsight we'll view that as kind of a tactical issue. I was very concerned in 21 and 22 that the Fed was 18 months late in actually slowing the bond buying and raising rates. That's more of a strategic issue. So I think, yeah, the Fed may in hindsight say they were late, but I don't think they're very late. And if they're late, it's by a meeting or two. It'll turn out to be tactical. And yes, you may see some time for these rate cuts to take their effect if the job market is weakening. But you got to remember, we've been in the midst of a very severe inflation fight, where inflation's been averaging since the end of 2020. It's been averaging almost 4.5% a year. We're way off what we wanted to be. And so I think the Fed was right in prioritizing inflation. And if that means they're a little late, regarding jobs. I actually, as a former FOMC member, I would have been willing to be a little bit late in order to wrestle this inflation bear to the ground.
So, Robert, is there a chance then if the inflation data shifts a little bit? Obviously, we've been on a good trend for the last couple months now. Chair Powell said he's gotten back to feeling a little bit more confident in the trend that we're seeing. But do you think there's still room then if the inflation trend changes back the other way again and we get a couple of surprises to the upside? Do they have the ability to stay on hold here to wait for inflation to keep coming down? Or is it just time to cut because of what we're seeing in the labor market?
My view is you'd like to see progress. However, there's debates about how restrictive the Fed is right now. My own view is that the neutral rate right now would be something more like 3.5 plus or minus. So I think the Fed is 175, 200 basis points restrictive. I think you can still fight inflation, but be less restrictive than they are. And so I think they've got room here to cut 2 or 3 times and still be fighting inflation. I know there's debate about that, and it's a theoretical question, but I think there's room to cut, and I think the balance of risk suggests it's the right thing to begin cutting in September.
Robert, I want to switch gears a little bit and ask about some of the political rhetoric we've heard around the Federal Reserve, right? Former President Trump has said he doesn't believe in Fed independence. It sounds like now his vice presidential candidate, J.D. Vance, agrees with him, thinks that politics should be a factor, should have some influence. And it seems like the other side, and Harris is saying she wants things to remain as they are. I mean, what recourse does the Fed have? How would this all go down? And I'm just curious your views on all of this.
Well, so the wisest thing the Fed should do, and I'm sure they will do, is ignore the rhetoric. History has shown, and other countries have studied the U.S. Fed for a reason. They have learned that an independent central bank is key to a successful economy. Now, there are parts of what the Fed does, like bank regulation, that is very influenced by whoever is in office. But an independent Fed that makes decisions on the Fed funds rate without regard to political influence or political pressure, I think is essential. We've learned that over history, and I don't think you want elected leaders or political leaders to be weighing in on monetary policy, particularly the Fed funds rate. And I'm still confident that cooler heads will prevail, and that would be the approach that overwhelmingly, I would hope advisors to any president would advise them to follow.